first stock exchange, Amsterdam, 1602, allowed the trading of company shares. Introduction: the birth of modern capitalism. The year 1602 marked a groundbreaking moment in economic history, the establishment of the world's first stock exchange in Amsterdam, Netherlands. This innovation laid the foundation for modern capital markets, enabling individuals and institutions to trade company shares and invest in businesses on a scale never seen before. Creation of this stock exchange was crucial in the development of capitalism, as it provided a structured marketplace where buyers and sellers could trade ownership stakes in corporations, facilitating the growth of global trade and economic expansion. Before the creation of the Amsterdam Stock Exchange, economic ventures had typically been funded by wealthy individuals or royal patronage, but the stock exchange revolutionized this process by enabling many small investors to contribute to the funding of ventures, significantly expanding access to capital. This innovation gave rise to the modern corporation and the concept of publicly traded companies. 1. The rise of joint stock companies. The need for investment. The rise of long-distance trade during the Age of Exploration, 15th to 17th century, opened up new opportunities for entrepreneurs to capitalize on international commerce. However, the sheer scale and financial risks of ventures like shipping expeditions or establishing colonies made it difficult for any single individual to afford such ventures alone. Large amounts of capital were required to fund these ventures, but it was a risky endeavor that could lead to total loss if ships were lost at sea or trade routes were disrupted. The joint stock company was a solution to this problem. It allowed multiple investors to pool their capital and share both the risks and the rewards of these ventures. In exchange for their investment, each individual was given shares or ownership stakes in the company. This structure provided the financial foundation for large-scale ventures and allowed for the funding of long-term projects. The Dutch East India Company (VOC). The Dutch East India Company, Verenigd Oostindische Company (VOC), founded in 1602, was the world's first publicly traded company. It was a joint stock company created to conduct trade with Asia, and it played a crucial role in the rise of the Amsterdam Stock Exchange. The VOC was granted a monopoly on Dutch trade in the East Indies, modern-day Indonesia, and became one of the most profitable companies of the time. To raise the capital necessary for its ambitious trade ventures, the company issued shares to the public, allowing anyone with enough money to purchase a stake in the company. The VOC's shares were listed and traded on the Amsterdam Stock Exchange, which enabled investors to buy and sell shares in a central, organized market. 2. The establishment of the Amsterdam Stock Exchange. The birth of a financial market. In 1602, the Amsterdam Stock Exchange was officially established as a place where shares of companies like the VOC could be traded. Located in the heart of Amsterdam, it was the first formalized market for buying and selling corporate stocks and bonds. The exchange was a revolutionary concept at the time. It offered a centralized location where investors could gather to negotiate the price of shares, trade them, and seek out buyers or sellers. Standardized the process of buying and selling shares, ensuring that transactions were conducted transparently and fairly. This allowed for the efficient raising of capital, as investors could now easily liquidate their shares if they needed to sell, and companies could access a large pool of potential investors. Key features of the Amsterdam Stock Exchange. The Amsterdam Stock Exchange had several important features that set it apart from other financial systems at the time. Transparency and regulation. The exchange established clear rules for trading, including the standardization of shares and the establishment of regulated procedures for buying and selling. This transparency built investor confidence and allowed the market to function efficiently. Public listings. Companies could now publicly list their shares on the exchange, and individual investors could buy and sell those shares. The market allowed the public to have access to investment opportunities that were once available only to the wealthy elite. Share trading. For the first time, shares could be traded on a secondary market, meaning that investors who bought shares in a company could later sell them to other investors. This made it easier for investors to exit their positions in a company and realize their profits or losses. 3. The impact of the Amsterdam Stock Exchange. The growth of capitalism. The Amsterdam Stock Exchange had a profound impact on the development of modern capitalism. created a system where businesses could raise large amounts of capital from a wide array of investors, thereby fueling the growth of the global economy. As more companies began to issue shares, the stock exchange became an essential part of the financial system. Capital for expansion. The capital raised through the stock exchange enabled companies to finance expansion, exploration, and trade. The Dutch East India Company, for example, used the funds it raised to build fleets of ships, establish trade networks in Asia, and develop lucrative commercial ventures. A risk diversification. The joint stock system allowed investors to share the risks of trade. If one shipment was lost, individual investors would lose only a portion of their investment rather than the entire amount. This lowered the risk for investors and made it more attractive to participate in global trade. The creation of financial markets. The establishment of the Amsterdam Stock Exchange also led to the creation of other financial markets. Over the years, stock exchanges were established in cities like London, Paris, and New York, all of which followed the model set by the Amsterdam Exchange. The success of the Dutch exchange demonstrated that trading stocks and bonds could be a profitable and efficient way of raising capital, and this system spread to other parts of Europe and beyond. The London Stock Exchange, founded in the late 17th century, would become one of the most influential financial centers in the world. The New York Stock Exchange, NYSE, founded in 1792, would go on to become the largest and most well-known stock exchange globally. 4 legacy and modern stock exchanges. Creation of the Amsterdam Stock Exchange marked the beginning of modern capital markets, and its influence can still be felt today. The basic principles of stock trading, public company listings, and investment diversification that were established in Amsterdam continue to form the backbone of today's financial systems. Creation of the first stock exchange transformed how businesses raised capital and opened up investment opportunities to a broader public. Global economy. The Amsterdam Stock Exchange contributed to the establishment of a global economy, where capital could flow freely across borders to fund industries, infrastructure, and technological innovation. Modern stock markets. Today, stock exchanges such as the New York Stock Exchange, NASDAQ, and London Stock Exchange are central to global finance, with billions of dollars traded daily. The legacy of Amsterdam's innovation. The establishment of the Amsterdam Stock Exchange in 1602 was a landmark moment in the history of finance. Transformed the way businesses accessed capital and created a new path for investors to participate in the global economy. The principles set in motion by the Amsterdam Stock Exchange continue to guide modern stock markets today, making it a foundational element of the capitalist system and global financial markets. Mercantilism dominates. 16th to 18th century influenced national economic policies. Introduction. The rise of mercantilism. Between the 16th and 18th centuries, mercantilism became the dominant economic theory and policy across Europe. This economic system was rooted in the belief that a nation's wealth and power were directly tied to its accumulation of precious metals, particularly gold and silver, and the balance of trade. Core idea of mercantilism was that a country's wealth was finite, and in order to grow, nations needed to export more than they imported, ensuring a positive trade balance. Mercantilism shaped the policies of many European powers such as England, France, Spain, and the Dutch Republic, and influenced their imperial ambitions. The economic strategies fostered by mercantilism led to the establishment of colonial empires, the growth of international trade, and the creation of early global economic networks. 1 core principles of mercantilism. The wealth of nations. Mercantilists believed that a nation's prosperity was determined by the amount of precious metals it possessed. Gold and silver were seen as the most tangible measure of wealth, and it was assumed that a nation's economic strength came from accumulating as much of these metals as possible. The central idea of mercantilism was that the world economy was a zero-sum game, that is, for one nation to become wealthier, another had to become poorer. This led to fierce competition between European nations, as they sought to capture resources and wealth through trade and colonial expansion. Favorable balance of trade. A key component of mercantilist thought was the importance of maintaining a favorable balance of trade. A nation should aim to export more than it imported, thus bringing in more money from abroad than it spent. By doing so, countries could increase their stock of gold and silver, the two pillars of mercantilist wealth. Mercantilist policies encouraged governments to intervene in the economy to ensure that exports exceeded imports. Nations would promote industries that produced goods for export, while imposing tariffs or restrictions on foreign goods to limit imports. Government intervention and regulation. Mercantilism emphasized state intervention in the economy. Governments enacted laws and policies designed to promote national wealth, protect domestic industries, and regulate trade. These policies included monopolies. Governments often granted exclusive trading rights to certain companies or colonies. Tariffs. High taxes were placed on imports to discourage foreign competition. Subsidies. Governments provided financial support to domestic industries, especially in manufacturing and mining, to boost exports. Colonialism. Nations established colonies to extract resources and create captive markets for their manufactured goods, further strengthening their economic control. 2. The role of colonies in mercantilism. Colonization of the Americas. During the 16th and 17th centuries, mercantilism played a crucial role in the establishment and expansion of European colonial empires, particularly in the Americas. The goal was to create colonies that would enrich the mother country by supplying raw materials and acting as exclusive markets for its goods. This created a colonial system that was designed to benefit the colonizing powers at the expense of the colonies themselves. Spain extracted vast quantities of silver and gold from its colonies in South America, using these resources to finance European wars and imperial expansion. England, France, and the Netherlands established colonies in North America and the Caribbean, focused on cultivating cash crops like tobacco, sugar, and cotton. These products were then shipped back to Europe, where they were processed and sold, further strengthening the national economy. The triangular trade. Triangular trade was a system of exchange that developed under mercantilist policies connecting Europe, Africa, and the Americas. European ships transported manufactured goods to Africa, where they were traded for enslaved people. These enslaved individuals were then transported to the Americas, where they worked on plantations producing raw materials for export to Europe. This trade network was immensely profitable for European nations but devastating for those involved in the slave trade. Colonial empires relied on the exploitation of their colonies' resources and labor, and mercantilism justified this system by asserting that the colonies existed to serve the economic interests of the mother country. 3. The impact of mercantilism on trade and industry. The growth of European commerce. Mercantilist policies spurred the growth of European trade by encouraging nations to seek new markets and secure valuable commodities. As European powers vied for control of overseas trade routes, they invested heavily in shipbuilding, navigation, and maritime exploration. The rise of global trade led to the establishment of powerful trading companies, such as the Dutch East India Company and the British East India Company, which were given monopolies on trade between Europe and Asia. These companies helped fuel the mercantilist economy by facilitating the flow of goods and wealth between continents. The rise of banking and financial instruments. As mercantilism spurred global trade, the demand for capital to fund voyages, plantations, and industries grew. The development of banking systems and financial instruments became crucial. European countries began to see the growth of stock exchanges and the creation of bonds and loans to finance expansion projects, including the establishment of colonies and the construction of infrastructure. This period also saw the creation of central banks, such as the Bank of England, founded in 1694, which played an important role in managing national finances and controlling the money supply to support mercantilist policies. 4. Criticism and decline of mercantilism. The rise of classical economics. By the late 18th century, mercantilism began to lose favor as economic thinkers like Adam Smith criticized its central tenets. In his seminal work, The Wealth of Nations, 1776, Smith argued that mercantilism's emphasis on government intervention and trade restrictions hindered economic growth. He proposed that free markets, where individuals and businesses operated based on their own self-interest, would lead to a more prosperous economy. According to Smith, wealth was not determined by the amount of gold and silver a country possessed, but by its ability to produce goods and services. Smith's ideas laid the groundwork for classical economics and the philosophy of laissez-faire capitalism, which advocated for minimal government interference in economic affairs. The decline of colonial mercantilism. The American Revolution, 1775 to 1783, and French Revolution, 1789 to 1799, challenged the mercantilist system. Colonial independence movements and the growing desire for self-governance led to the dismantling of imperial systems that had been structured around mercantilism. Former colonies sought to establish free trade policies and trade with multiple nations, rather than being restricted to the exclusive trade relationships mandated by mercantilist policy. The legacy of mercantilism. Although mercantilism began to lose its dominance by the late 18th century, its impact on global economic development cannot be overstated. Played a key role in the rise of modern capitalism, the growth of international trade, and the establishment of colonial empires. Mercantilist ideas shaped the course of history by encouraging economic expansion, the growth of global trade networks, and the creation of powerful financial institutions. Despite its eventual decline, the mercantilist era helped pave the way for industrialization, imperialism, and the rise of global capitalism. The ideas that emerged during this period would continue to influence economic policies and systems in the centuries to come.